Welcome to the True P&L Deep Dive. Before we start, a quick disclaimer. This analysis is for educational purposes only. The views expressed are solely my own. Adjusted data is based on my proprietary analytical models and may differ from officially audited financial statements. So today we are diving deep into the HNB Q3 2025 results and, well, the headline numbers. They feel less like a quarterly report and more like an accounting magic show.
They really do.
Our mission, as always, is to get past that press release glitter and find the true P&L for this institution.
It's absolutely essential we cut through the noise on this one. I mean, the initial data presents such a staggering cognitive dissonance.
Yeah.
We're looking at HNB reporting that profit attributable to equity holders surged an unbelievable 45.5% year over year.
45.5%.
Which translates to Rs 33.48 billion in profit. That's a monumental number by any measure.
And that 45.5% explosion is the puzzle, isn't it? It's the puzzle we're here to solve, because right next to that massive number, the core engine of the bank, the very reason it exists, its bread and butter, is struggling.
You're talking about net interest income.
NII.
Exactly. The difference between what the bank earns on its loans and what it has to pay out on its deposits.
And that NII, it only grew a modest 6% year over year.
6%.
This is the central anomaly. It's the chasm that defines this whole deep dive. How on earth can a bank's headline profit soar by nearly 45.5% when the fundamental business of lending, that core income engine, only managed to increase its revenue by 6 percentage points?
That gap, that spread of nearly 40 percentage points, it suggests one of two things. Either HNB has fundamentally changed its business model overnight,
Which is highly unlikely.
or there is a massive, non-recurring, one-time accounting event that is just inflating those headline numbers. We're here to find out which it is and whether that 45.5% growth is sustainable or, just a mirage.
Let's find out.
Okay, let's unpack this core engine because the NII growth story it's genuinely puzzling. Now, that 6% increase is low by any historical standard, but it looks particularly poor when you factor in the sheer volume of lending the bank did.
Right. The source material shows HNB expanded its loan book by a whopping 26%. They pushed the total loan book size to Rs 1.39 trillion.
And that metric, the 26% loan book expansion, it tells us that the bank is effectively executing its market strategy. They're successfully originating new loans. They're growing market share, no question. But the fact that a 26% volume expansion only resulted in 6% II growth is a screening indicator of margin destruction. The intense pressure of the current macroeconomic environment it's everywhere in this calculation.
Okay, let's talk mechanics. For you listening, especially if you're newer to bank analysis, why doesn't a 26% increase in, let's say, product volume translate into anything close to a 26% increase in revenue?
Well, it boils down entirely to the repricing dynamic in a declining interest rate environment.
Okay.
The source specifically highlights that margins compressed because falling interest rates caused the bank's assets, which are primarily their outstanding loans, to reprice downward much faster than their liabilities, which are the customer deposits.
So when rates drop, the return on their existing loans just shrinks almost immediately. The interest they collect on floating rate loans adjusts very quickly to those lower market rates.
Precisely. And any new loans they issue are immediately priced at these new, lower prevailing rates.
Yeah.
But, and this is the key, the bank cannot and will not cut deposit rates at the same speed.
Why not?
Well, if they aggressively cut the rate they offer on savings accounts or fixed deposits, they risk an immediate outflow of customer funds. They risk losing their low-cost funding base. Banks will always prioritize funding stability over margin speed. It creates a lag.
So it's a profitability squeeze. They're making less money per dollar they lend out, but their cost of capital, their funding base, it stays stubbornly high because they have to keep depositors happy.
That dynamic is perfectly captured in one key metric, the net interest margin, or NIM. This is the crucial number for core operational profitability. HNB's NIM compressed severely, dropping from 4.86% in 2024 all the way down to 4.17% in Q3 2025.
Wow, that's a big drop.
That 69 basis point compression is enormous. And it provides the entire answer to why 26% volume growth only netted 6% income growth. They're sacrificing unit profitability for market share.
Let's use that bakery analogy we sometimes talk about, just to make this tangible for everyone. Imagine you're running a really successful artisanal bread bakery. Last year, you sold 100 loaves, and your profit on each loaf was, say, $1.
Yeah.
This year, you've increased your production, your distribution. You're now selling 126 loaves, a massive 26% volume increase. But because the market price for bread has been slashed, your profit per loaf is now only 25 cents.
That's a powerful simplification, but it's spot on. You've dominated the market, you've shown superior growth in volume, but your total cash register profit is up only marginally.
Exactly.
In the bank's case, the 26% loan growth shows powerful distribution capabilities. They have the systems, the branches, the underwriting to push volume. But they're paying a heavy, heavy toll for that volume expansion in the form of severely compressed unit economics. The core lending engine is definitely firing on volume, but it's choked on margin.
So the immediate takeaway is that the operational performance is much weaker than that 45.5% headline profit would have you believe.
Much weaker.
Since the core engine is choked, we have to look for operational success somewhere else. If NII is struggling, where did the bank find the momentum? And this brings us to the growth story that I find, genuinely encouraging: diversification.
Absolutely. This is the silver lining of the report. While NII disappointed, the fee and commission income segment surged a substantial 27% year over year. It hit Rs. 17.61 billion.
And that's high-quality revenue.
It's structurally high-quality revenue. It's exactly what we look for in mature financial institutions.
And the source material breaks down what's fueling this, right? It's digital banking, transaction services, card operations.
Right. And this tells us HNB is successfully transforming from just a balance sheet lender into a holistic financial service provider. They're monetizing their infrastructure.
And the quality difference between fee income and NII, especially right now, is huge, isn't it?
It's crucial. Fee-based revenue is largely insensitive to interest rate movements. If rates continue to fall, NII suffers. But people still use their credit cards, they still process payments, they still use their digital wallets. This provides a defensive moat.
So it insulates a big chunk of their earnings from the macro volatility that's just crushing NII.
Exactly. The 27% growth here suggests management has successfully built a secondary, profitable, and structurally sound engine.
It's the move from relying just on the price of your core product to successfully charging for utility, for convenience, for the services built around that product. I think that 27% growth is a great sign of system penetration and stickier customer relationships.
I agree. However, we have to look at the other major operational lift, which is, well, it's less structural and far more volatile.
It's exchange income.
Exchange income. This segment saw a dramatic swing from a Rs. 2.0 billion loss in the prior year to a Rs. 4.2 billion gain this year.
That's a phenomenal Rs. 6.2 billion swing right there on the total line. That's enough to move the needle significantly. But, putting my critical analyst hat on, I have to be wary of this income.
You should be.
The source ties this rebound directly to FX transactions from increased vehicle imports.
And that specific link vehicle imports immediately raises a red flag about sustainability. Vehicle imports are notoriously cyclical. They're heavily dependent on government policy, trade balances, consumer confidence.
So if, say, the central bank decides to tighten monetary policy or impose import restrictions again,
that entire Rs. 4.2 billion stream could just dry up in a single quarter.
So we have two types of growth outside of NII. We have fee income, which is structural. It reflects digital transformation, customer behavior. That's good, stable growth.
Right.
And then we have exchange income, which is opportunistic. It reflects favorable government policy and macro swings. It's volatile and totally unreliable for future forecasting. We'll take the money, but we certainly won't budget for it next year.
Well said.
Now, let's turn the lens toward efficiency. We saw total operating income grow by a very respectable 20%, driven largely by those fees and FX. But operating expenses, OPEX, also rose by 22% year over year, hitting RLS's 63.85 billion.
And this is the first yellow flag in the operational review. Your costs are outrunning your top-line revenue growth. 22% EVEX growth versus 20% operating income growth.
And if costs keep growing faster than revenue,
it immediately erodes your operational leverage. It's a worrying sign for the long-term trend.
Can we break down those rising costs? What is the bank dealing with here?
The breakdown pretty much confirms what we're seeing across the entire economy. Inflationary pressures. Personnel costs rose 18%, which reflects wage adjustments you need to make to retain talent in this environment.
Okay, that makes sense.
But other expenses jumped even higher, 23%. And this covers everything from utilities, maintenance, marketing, and the crucial technology investment that's necessary to maintain that 27% fee income growth we were just praising.
So it's a necessary evil then. They're generating quality income, but inflation is acting as a massive drain on those gains. The high OPEX growth isn't necessarily waste. It might just be the cost of doing business right now.
Exactly. And to prove whether that high cost is being managed effectively, we turn to the cost-income ratio, the CI ratio. Despite that 22% BX jump, the bank's operations remain highly efficient. They're maintaining a CI ratio of 38.90%.
And that 38.90% needs context. For you listening, that means the bank is spending 38.9 cents to generate one full dollar of revenue. Anything consistently below 40% is usually seen as a hallmark of excellent discipline management in the banking sector.
It is. It's far below what many regional peers report, which suggests HNB has already done a lot of cost optimization in prior years. But let's stick with our skeptical analyst hats for a moment.
Always.
We established that total operating income grew 20% and OPEX grew 22%. So while the base level of 38.90% is fantastic, the trend is negative. Management has to demonstrate that those new expenditures are generating disproportionately higher revenue in Q4 and into 2026.
Otherwise, that efficiency level will start to slide up toward mid-40s.
And that would be a serious concern for profitability. The pursuit of growth can't compromise efficiency.
So the CI ratio tells us how efficiently they operated, but now let's ask where the profit actually came from. Looking at the profit before tax, the PBT contributions, this segmentation reinforces the idea that core lending is not driving the show.
The segmentation is very revealing. Retail banking leads the charge, as you'd expect, delivering RI 11.18 billion in PBT. Retail is the engine for stability. It provides that low-cost funding base we'll talk about later. But what comes in second is the strategic decision maker, Treasury.
Treasury is clocking in at RI's 10.24 billion PBT. It's nearly matching retail banking. And corporate banking is significantly behind, contributing just RS 5.93 billion.
That RS 10.24 billion from Treasury is a massive compensation mechanism. It means HNB is relying heavily on its investment portfolio, its bond holdings, its management of liquid assets, trading securities, to compensate for that low 6% II growth in traditional lending.
This raises a critical question, and we need to be careful here. Isn't relying so heavily on Treasury almost a sign of, well, a sign of failure in the core lending business? You're playing the capital markets to make up for margin compression in your primary job.
That is the perfect professional skepticism we need.
Is that a sustainable long-term strategy, or is it just highly effective opportunism in a specific rate cycle?
It is undeniably opportunistic. Management is seeing low returns on new lending because of the NIM compression, so they are strategically deploying capital into other assets, like short-term government securities, where the yield is momentarily better, or where they can realize capital gains from falling bond yields. It's a tactical choice that shows a flexible balance sheet.
But flexibility comes at the cost of volatility, doesn't it? That RS 10.24 billion is much less predictable than the Rs 11.18 billion generated from millions of retail transactions.
Absolutely. Treasury performance is often subject to interest rate fluctuations and market sentiment, which can reverse very quickly.
So the risk is concentration.
Yes. If market interest rates stabilize or rise, the value of their existing fixed income portfolio could fall, creating potential losses or reducing the realization of gains. This large Treasury contribution adds a layer of market risk to the earnings profile that wasn't as prevalent when traditional NII was a dominant profit driver. It's profitable, but it's inherently less predictable for forecasting future returns.
So this massive Treasury contribution, it highlights a strategic pivot. They are taking liquidity, not putting it into long-term loans with compressed margins, but into medium-term, higher-yielding securities. The question for you listening is whether you view this RSS 10.24 billion as a sign of smart, tactical management or a worrying dependence on market movements.
And that difference between structural stability and market opportunism is exactly why we should probably pause here. This data point is arguably the most subjective piece of the entire report. If you're tracking this bank, we'd encourage you to like the video, subscribe, and share your own analysis of this Treasury segment's size.
Yeah, we'd love to hear it. Do you see it as strategic brilliance or a volatility risk?
We love seeing how you interpret these complex segmental breakdowns.
We do.
Okay. We've established that the core lending business is subdued, and Treasury is acting as a major but volatile profit filler. Now let's move to the final piece of the profit equation, the single biggest factor behind that shocking 45.5% profit surge.
The game changer.
This is where the detective work pays off. We began with a 45.5% profit surge and the 6% NII reality. The gap is the RSL 11.2 billion swing from impairment adjustments. This is the definition of noise.
This is the non-recurring event that fundamentally distorts the headline figure and makes the bank look far more profitable on paper than it is operationally. And this requires us to apply our first rule of advanced analysis. Always strip out one-time gains to assess true operating power.
Let's simplify the numbers because this is where the accounting double whammy happens. Okay, so in the current period, HNB booked a massive R6.94 billion impairment reversal. Now, think of impairment as the provision the bank sets aside for loans it expects might go bad.
Right.
A reversal means the bank looked at loans it thought were bad, realized the economic climate improved, and decided those loans are now safe enough to release those provisions back into the income statement as profit. It's essentially income from unlosing money.
Okay, income from unlosing money. I like that. But the swing is amplified because we compare this to the prior period, Q3 2024. Last year, they recorded a Rs 4.27 billion impairment charge.
Which was money subtracted from profit to set aside for bad loans.
Right.
So when you look at the year-over-year comparison, you get this huge difference. Rs 6.94 billion added to profit this year versus Rs 4.27 billion subtracted from profit last year. That nets out to a gigantic total P&L swing of Rs 11.2 billion in the bank's favor.
And that single Rs 11.2 billion figure accounts for the vast majority, if not all, of the profit difference between that 6% core NII growth and the 45.5% reported profit growth. It's an accounting boost. It reflects a balance sheet cleanup, not superior, recurring operational profitability.
And while the reversal is fundamentally a positive signal, it shows their loan quality improved faster than expected. It must be immediately discounted for forecasting purposes. If we were calculating an adjusted core profit, we would remove that Rs 6.94 billion reversal.
And once you do that,
the operational profit growth for the quarter looks far more modest, probably in the low double digits, which aligns with the combined growth from NII and fees.
So it's excellent news for the balance sheet, but it's pure noise for the income statement projections.
Yeah.
When we look at the source material, the emphasis on this cleanup being the primary driver forces us to be incredibly cautious about using that 45.5% figure to project the bank's profitability into 2026.
You have to be. If you fail to zero out this non-cash, non-recurring item, you will massively overestimate future profitability.
Got it.
So now, after stripping out that accounting noise, we move to the ultimate test of earnings integrity, cash flow quality. Accounting profit can be subject to all sorts of things, timing differences, accruals, provisions. Cash flow is the undeniable reality of money physically moving in and out of the bank.
Time to apply our second rule. Cash is king.
Cash is king.
We are going to aggressively compare the accounting profit against the hard cash generated. Let's look at the numbers from the source.
Okay, the adjusted net operating cash flow for HNB is Rs 47.70 billion. This is the physical cash generated by the bank's operations. We get this by taking the operating profit of Rs 55.55 billion and subtracting the actual tax paid of Rs 7.85 billion.
Okay, 47.7 billion in cash. And we compare that against the net profit, the accounting figure, which is Rs 34.73 billion.
And this comparison gives us the cash conversion ratio, the CCR, which is a remarkable 1.37x.
1.3.
This is the ultimate validation of earnings quality. Our advanced lesson 2 tells us that a CCR above 1.0x means the reported accounting profits are fully cash-backed, with surplus cash generation beyond what was even reported.
So the 1.37 in CCR is like finding out your neighbor who drives a fancy car, that's the high reported profit, actually has enough cash flooding his bank account that he could buy 2 more cars if he wanted to.
That's a great way to put it. It confirms that the Rs 34.73 billion profit is not just real, but the bank generated a significant surplus of physical cash from its daily operations.
And this is a crucial point that, it mitigates some of the skepticism we had about that impairment reversal.
It does. Even though the impairment reversal is a non-cash, non-recurring entry that boosted the profit number, the sheer volume of operating cash flow confirms the fundamental operational health. If the bank was struggling to convert its sales into actual collected money, we would see a CCR well below 1.0x.
But they're at 1.37.
The 1.37x ratio provides a bulletproof foundation for the bank's financial statements.
And this foundation is the bedrock for assessing something like dividend sustainability, right? Investors need to know that the dividends they receive aren't based on paper profits, but are funded by recurring, predictable cash flow.
And we can verify this easily. Dividends paid totaled Rs 8.48 billion. Compare that against the robust adjusted operating cash flow of Rs 47.7 billion.
Yeah.
The payout ratio is extremely low. The dividend is fully sustainable.
So it's comfortably funded by recurring operations.
And it's essentially guaranteed by this level of cash generation. This is a fortress dividend payout backed by verifiable cash.
Okay, we've established that the bank is generating a huge cash surplus. Now let's look at what they did with that cash. The source notes something that would raise a major red flag in almost any other sector. Cash and cash equivalents decreased by Rs 41 billion.
Right.
If I see a non-financial company's cash pile drop by that much, I immediately suspect trouble.
But for a bank, context is everything. The analysis is crucial. We have to determine if that cash was used to cover operating losses or deployed into earning assets. In the banking sector, if you are growing your loan book, cash equivalents must fall.
And HNB confirms this was good cash consumption. They actively managed the balance sheet by deploying that capital into assets designed to generate future income.
And the numbers back this up perfectly. The bank deployed capital sufficient to fund Rs 287 billion in loan growth. That's the 26% loan book expansion we talked about earlier, and significant securities investments in the Treasury segment.
So they took Rs 41 billion that was just sitting in their lowest yielding assets cash equivalents and strategically moved it into their highest yielding assets, loans, and securities.
Which demonstrates highly active and smart Treasury management. They aren't sitting on dead money, allowing it to inflate. They are capitalizing on the opportunity presented by the large loan demand and the yields available in the securities market.
It's the hallmark of a disciplined balance sheet.
It is. They're maintaining the necessary regulatory liquidity, but ruthlessly managing the rest of the capital to maximize the yield curve. The Rs 41 billion decrease isn't a deficit. It's the result of funding the Rs 287 billion asset growth. They are sacrificing zero-return short-term liquidity for long-term NII and Treasury income generation.
Okay, so having confirmed the quality and quantity of the profits, we turn to the strength of the balance sheet. If the income statement benefited from an impairment reversal, the balance sheet has to show concrete proof of improving asset quality.
And this section of the report is universally positive. The improvement in asset quality is arguably the most impressive metric here, confirming the bank has successfully navigated the worst of the economic cycle.
What's a number?
The Stage 3 non-performing loan ratio, the NPL ratio, improved dramatically to 1.36%. That's down from 1.88% in December 2024.
A 1.36% NPL ratio, especially for a bank of this size in this economic climate, is truly exceptional by any standard. It suggests two things. First, that the underlying economy for their borrowers is recovering, and second, that their underwriting standards are stringent and effective.
And this reduction in NPLs is the tangible proof that validates that Rs 11.2 billion impairment reversal we discussed earlier. The accumulated Stage 3 impairment dropped from Rs 83.4 billion to Rs 76.5 billion for the group.
And that reduction means those risky assets have either performed, been recovered, or restructured,
allowing the bank to release those precautionary provisions back onto the P&L. It's a cleanup operation that signals real confidence in the future credit environment.
And crucially, the bank is still being conservative about the 1.36% of loans that are still bad. The provision coverage stands at 75.64%.
And that 75.64% provision coverage means that for every dollar of defaulted loans, they have already set aside 75 cents to cover the potential loss. This confirms that the bank is not only seeing improving quality, but is also robustly protected against the remaining bad loans.
So it's a combination of extremely low NPLs and high provision coverage,
which creates an impenetrable level of resilience for the balance sheet. They have absorbed the stress and are now operating from a position of monumental strength.
So a healthy bank has to secure three things: quality assets, strong capital, and cheap, sticky funding. We've covered assets and profit quality. Let's look at the funding side liquidity. Deposits expanded a very healthy 10% year over year, reaching RMS 1.93 trillion.
That is robust organic deposit growth. It provides the necessary raw material for continued loan expansion. But the key metric for strategic flexibility is the loan-to-deposit ratio, or LDR.
And HNB's LDR sits at 72%. That's Rs 1.39 trillion in loans divided by Rs 1.93 trillion in deposits. From an analyst perspective, what does a 72% in LDR tell us about their competitive position?
It indicates significant headroom. Massive headroom to expand lending without any liquidity strain whatsoever.
Yeah.
Think of LDR as the bank's lending capacity gauge. If a bank is running close to 90% or 100% LDR, they are effectively maxed out. They have to aggressively chase new, often expensive deposits to fund the next loan.
But at 72%.
At 72%, HNB has a massive competitive weapon. They can comfortably pursue that aggressive 26% loan growth target without worrying about funding stability or resorting to expensive wholesale funding.
And that LDR cushion allows them to be selective and keep their borrowing costs down, which ties directly back to defending that net interest margin we identified as being under so much stress.
Precisely. And the quality of the funding base is the ultimate defensive mechanism against margin compression. We look at the SASR ratio, which stands for current accounts and savings accounts.
The cheap money.
The cheap, stable, sticky funding a bank can acquire. HNB's FASR ratio stands at 33.5%, which means RS 646.75 billion of their total deposits is cheap, high-quality funding.
Let's use another analogy. SASI funds are like borrowing from family. It's cheap, it's reliable, and it generally doesn't leave the bank unless the family is in genuine distress. It's essentially zero-cost or very low-cost capital for the bank.
And that low-cost, sticky funding base is the necessary counterweight to the asset repricing pressure. Even if the bank has to lower its lending rates quickly, the fact that one-third of its funding costs are practically static held in those low-yielding CASA accounts allows them to defend that 4.17% IM, compressed though it may be.
So the 33.5% CASA ratio gives HNB a crucial structural advantage over competitors with less favorable and therefore more expensive funding mixes.
It's a crucial moat that protects long-term core profitability.
We've established resilience in assets and liquidity. Now for the final safety factor, capital. And this is where the bank reaches. Well, peak financial prudence, possibly to a fault.
HNB is not just slightly above regulatory minimums. They are massively, perhaps inefficiently overcapitalized. Let's just look at the buffer.
The Tier 1 capital ratio is 18.83% compared to a regulatory minimum of just 9.50%. The total capital ratio is 22.07% versus a minimum of 13.50%.
The buffer is enormous. Their highest quality, most loss-absorbing capital is almost double the required minimum. For anyone concerned about systemic risk or economic shocks, this balance sheet offers bulletproof safety. This is a capital bastion designed to weather any storm.
But our advanced lesson 3 highlights a major strategic issue for investors: the overcapitalization trade-off. While safety is great, excess capital limits the return on equity, the ROE, upside. Capital is expensive to carry if it's not being put to work.
Exactly. When your equity denominator, the capital, is unnecessarily large relative to the profits you generate, your ROE must, by definition, be lower than its potential. The bank is so safe that it is arguably inefficiently safe for shareholders who are focused on maximizing returns.
And we can quantify that inefficiency easily. The bank is sitting on a staggering 9.3% Tier 1 capital buffer above the minimum requirements. That's 18.83% minus 9.50%. That 9.3% buffer represents capital that must be deployed or returned to shareholders.
This is the single most critical strategic question management faces today.
So what are their options?
Well, let's spend some time on the deployment strategies because this decision will define the bank's future ROE trajectory. Management has 3 primary avenues for utilizing this excess capital.
Option 1. Aggressive lending expansion. They use that 9.3% capital buffer to support even more than the current 26% loan book growth. This would use their 72% LDR headroom and massive capital base, increasing their asset base and driving future NII. It's the organic growth strategy.
But it's slow, especially with compressed NIMs.
Right. What's option 2?
Increased cash returns via higher dividends. This is the classic path for mature, stable institutions. They increase the dividend payout, providing immediate, predictable cash returns to shareholders. This is great for income investors, but it doesn't fundamentally change the ROE structure.
And option 3, which often provides the most immediate and mathematically compelling lift to return on equity.
A share buyback program. If management believes the stock is undervalued, they can use that excess capital to repurchase shares. This reduces the total outstanding equity denominator while maintaining earnings, which dramatically and immediately boosts the ROE per share metric.
And the fact that they achieved a strong ROE of 17.35% despite this massive capital surplus suggests that their underlying profitability is truly exceptional.
It does. If they efficiently deployed just half of that 9.3% capital buffer using a buyback strategy, the ROE could easily jump well over 20%. The ambiguity around which path management will prioritize is the critical investor watchpoint for the next few quarters.
So until that capital is actively put to work, it remains a structural drag on maximizing shareholder returns. Safety is paramount, but efficiency is the key to valuation. The next communication from management really needs to address how they intend to optimize this capital structure.
We need to see the move from being safe to being safely optimized. The choice between funding aggressive asset expansion in a compressed margin environment versus returning capital via buybacks is a tough strategic call, and the outcome will dictate the bank's investment profile moving forward.
That was a comprehensive deep dive. We moved from that shocking 45.5% profit headline to uncovering the true operational core of the bank. Let's do a rapid-fire review of the most critical quality metrics we uncovered.
Let's do it. First, the headline success despite the structural constraints. Return on equity, ROE, remains strong at 17.35%.
But the core profitability engine is strained. Net interest margin, NIM, is compressed to 4.17%.
Operationally, efficiency is maintained. The cost-to-income CI ratio is highly disciplined at 38.90%.
The ultimate confirmation of balance sheet strength. The NPL ratio is a best-in-class 1.36%.
And crucially, validation that profits are real.
The cash conversion ratio, CCR, confirms excellent cash backing at 1.37x.
Finally, the long-term value creation metric, net asset value, NAV per share, grew 11% year-to-date, sitting at Rs 508.51. So the final synthesis is clear. We stripped out the RDI, 11.2 billion noise from the impairment reversal, and we found a solid, structurally sound operating core. HNB operates a capital bastion balance sheet with exceptional asset quality and robust cash generation, proven by that incredible 1.37x CCR. Their diversification into fee income and strong CASA funding provide critical defensive moats against macro headwinds.
But the caution remains on the compressed NIMs and that reliance on Treasury and the non-recurring impairment reversal for the headline surge. That 45.5% profit jump is not sustainable purely from core operations yet. Future growth has to be driven by either margin recovery in NII or continued structural expansion in fee-based income.
The investment profile here is that of a premium quality franchise built for resilience and stability. It is ideal for investors who value balance sheet strength, safety, and sustainable cash-backed dividends over high-flying, aggressive growth heroics.
And this marks the end of our deep dive. We encourage you, our listener, to use this extensive analysis to conduct your own comprehensive due diligence. If this analysis provided value, please hit that like button, subscribe for future deep dives, and ensure you engage with the community by sharing your perspective on HNB's strategic direction. And remember, as we reiterate for all serious research, this is not financial advice. Always conduct your own due diligence.
Before we sign off, let's leave you with the central strategic dilemma HNB's management faces, linking their capital adequacy directly to shareholder returns. Given the compressed NIMs and that enormous 9.3% Tier 1 capital surplus above the regulatory minimum, the bank has a crystal clear choice.
They have to choose between aggressively expanding the loan book further to utilize the capital for asset growth, betting on eventual margin recovery, or prioritizing a share buyback program to immediately re-engineer their equity structure and boost ROE. So if the bank's goal is to maximize return on equity in the short to medium term, which move is mathematically superior? And perhaps more practically, what operational or market signals will we see in the next quarter that tell us exactly which path management has chosen first?
That deployment decision is the future of HNB's profitability and something every investor must monitor closely. Think about that strategic choice until our next deep dive. We'll see you next time.